from the world of politics.
This issue of cyber attacks on our critical infrastructure, especially energy infrastructure, is not going away.
To the world of business.
We still think the trend is going to be a strong job growth and recovery.
This is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, welcome to Balance of Power. We're going to start with some breaking news right now. Fed Governor Lael Brainerd is appearing right now at a virtual event hosted by the SABEW, and in her prepared remarks, she is talking about inflation. We're going to take you through a few of the headlines here that are in the prepared remarks. The Governor Brainerd is saying inflation is tough to predict. It may be transitory. There's uncertainty that remains, jobs inflation, and far from goals. Data show price expectations well anchored at 2%, Governor Brainerd says. She says the second quarter looks stronger than the first quarter, and the outlook is bright. And now we're going to go to our correspondent, Michael McKee, who has been looking at the prepared remarks. Mike?
David, yes, Lael Brainerd is helping the chairman of the Fed, Jay Powell, push back against the idea that seems to be prevalent on Wall Street today. Inflation is a major danger. She says that the latest jobs report is a reminder that the path of reopening and recovery, like the shutdown, is likely to be uneven and difficult to predict. So basing monetary policy on outcomes rather than the outlook will serve us well. She notes there are a number of impediments, and we've talked about these, to moving forward in the economy, to getting more people hired, including the fact that a lot of people don't want to go back to work because they're still concerned about the virus or not vaccinated. Childcare, a lot of schools not open yet. And she also notes that job losses are disproportionately concentrated in the high contact areas, restaurants, leisure, hospitality, and that's going to take a while to overcome. Fiscal support, meanwhile, she says, is helped households and helped the economy because they've accumulated savings, but a lot of the spending momentum we see this year will fade into next year, and therefore it shouldn't be an inflation problem. Bottlenecks, she said, are there. They're pushing up prices now, but they should start clearing. She notes that a lot of the manufacturing bottlenecks in Texas that were caused by that February storm have started to clear very quickly. She says demand is probably going to slow from where it is in the second quarter. And she says remaining patient through the transitory surge associated with the reopening will help ensure that the underlying economic momentum that will be needed to reach our goals as some current tailwinds shift to headwinds is not curtailed by a premature tightening of financial conditions. So the Fed holding up the stop sign. Don't worry, Wall Street. We are on the job.
Yeah, Mike, to ask the unfair question, how can we be confident it's transitory when she says it's very uncertain? How do we know it's transitory? And I understand the Texas storms. The storms went away. I'm not sure, for example, the microchip problem is going away.
Yeah, she notes the microchip problem is going to be with us for a while. She also notes that shipping and transportation bottlenecks will be with us for a while, but they will work themselves out over time, and that shouldn't lead to sustained inflation. She says what you need to get the kind of inflation Wall Street's worried about is not just a single price increase or a couple price increases going into the fall. You need to show that prices are going to continue to rise on a regular basis, and the Fed doesn't think that's going to happen.
Okay, thank you so very much to Bloomberg's Michael McKee for the report on Lael Brainerd's remarks. It's not just Governor Brainerd who is focusing on inflation. Markets have been moving on inflation concerns just today, and Dallas Fed President Robert Kaplan told us yesterday that he is seeing employers raise wages and even offer bonuses to hire the employees that they need.
We're hearing across the board for unskilled workers as well as skilled workers, but notably unskilled workers. Businesses tell us they're either offering higher wages, but that's not doing it to get people back, and they're offering bonuses, signing bonuses. In other words, the demand from these businesses to hire is greater than you saw in the growth in employment there.
To take us through the numbers now and what the numbers are telling us about prospects for inflation, we welcome now Torsten Slok. He's Apollo Global Management Chief Economist. Torsten, great to have you back with us. So we hear on the one hand, Lael Brainerd says, don't worry about it, it's only transitory. On the other hand, it sounded like Dallas Fed President Kaplan was saying he is starting to see some wage inflation.
Yeah, there's a sharp contrast between those two messages. I mean, Kaplan yesterday laid out a number of very convincing notes on your program and saying from the anecdotal perspective, it's very clear that there's a lot of signs that the labor market is tightening and that there's upward pressure on prices. If you look at some of the data from the NFIB, you see also that small businesses in particular are planning to raise average selling prices at the highest rate basically in several decades. Also, businesses are saying that labor shortages, also from the NFIB survey, are very substantial. So he's basically telling the story that he's seeing a lot of anecdotes, he's hearing a lot of stories about what's going on. And at the same time, Brainerd here in what you're just talking about now seems to be much less worried and talk about this in more dampened terms, if you will, and not worried about what this might mean from say, a several quarter perspective. So the bottom line is that there is a very heated debate, and as you and Mike also just spoke about, including on Wall Street, about how overheated is the economy and how permanent is this rise in input costs and in prices that we're seeing at the moment.
Yeah, and I wonder about when we're going to start seeing this at the consumer level. We are hearing it from companies saying they have increased input costs in various senses, perhaps because of supply chain problems, perhaps something else. Going back to the NFIB that you referred to, 44% of the people in the survey said they're having trouble filling jobs, which would suggest they're going to have to pay more money. When do you think we'll start seeing it in real consumer price inflation?
Yeah, so the risk, of course, here is that not only are we seeing the pressures on input prices, the risk is also that some of these indicators are suggesting that that might lead to higher output prices, meaning higher selling prices. And on top of that comes this issue that inventories are very low. So a lot of the stuff in the supply chain that normally comes on inventory is just now, in particular for retailers, at historical, again, decade low levels. So that means that if you are a seller of goods in retail, and suddenly you have very little inventory, you are almost incentivized to say, well, I have so little inventory, but I have so many customers. So why don't I start raising the prices of the goods that I have on my shelves? So to your question, David, I think that I think everyone agrees that there is a transitory increase in inflation. But the question is, are these kinks in the supply chain just easily squared out over the next quarter or two? Or is there a risk that we might transition from these temporary problems, if you will, to a more permanent problem with inflation simply being elevated for longer? And that's what the market is debating so heavily, including very prominent participants in the market, Stanley Druckenmiller today in the Wall Street Journal, saying very clearly that the Fed is not at the right spot relative to where these risks are. So the debate continues and is getting more and more intense.
Torsten, as an economist, how much attention do you pay to the markets? And I'll give you two market indicators. First of all, the yield on the 10-year, which is going back up again today. We're up over 1.6. People are saying it may well get to 2. And commodities prices, goodness sake, some of those commodities prices are at record levels or near them.
Yeah, so that's right. I mean, prices of everything, corn, sugar, wheat, everything when it comes to, broadly speaking, agricultural products have gone up dramatically. And if you all look at inflation expectations in markets, meaning tips break-evens, are also at record highs or at the highest levels, at least in a long, long time. And to your question then, how much weight should one put on these different things? Well, what is, of course, very important is to remember that through the pandemic, the Fed basically bought half of all Treasury issuance. So a very important reason why rates are still so low is because the Fed is still very aggressively buying 80 billion in Treasuries every single month. The Fed at the moment holds roughly around 40% of all Treasuries with a maturity of 10 years or more. So in that sense, the central banks, and this is the same thing in Europe, central banks around the world are still playing a very active role in holding rates down. So that's why this debate that Stan Druckenmiller started today really about, well, do we need emergency monetary policy in a situation where things are getting more back to normal? In particular, as you mentioned also earlier, retail sales has really started going up quite significantly. And with the consumer coming back so strongly, there is a very important disconnect between where 10-year rates are trading compared to the strength of the recovery that we're seeing at the moment.
Well, and Torsten, I wonder, this is something we did talk to Rob Kaplan about yesterday, has the new framework that the Fed has adapted for how they're going to deal with inflation maybe given them a certain, actually painting themselves in a corner, because they say it's got to be over 2% to average 2%. And by the way, it has to be there for an extended period of time. We want to see the actual results. Is there a risk there that they will not be able to pivot quickly enough?
I absolutely agree with that, David. And I think the risk is really simple, that most people working at the Fed, they have a PhD in economics, and that's a great background. And you really look at things at a very high level and say, we can ignore food and energy. That's not how we think about inflation. And also say, well, we don't really necessarily look at individual sectors and worry about individual things from that perspective. We care about things from the very high level. But if you are a business manager, or let's say in the very practical corporate finance perspective, you're an MBA and you sit in a company and you see very high prices of inputs, you don't have the luxury of saying, oh, I know the economy is saying that this might just be temporary, or this is just food and energy. You're saying, well, my profit margin is getting squeezed. So in that sense, when profit margins get squeezed, you do need to act, and you therefore will see different behavior from sort of the companies or the corporate finance perspective relative to this very helicopter high-flying perspective that economists, and in this case the Federal Reserve, has. So I do think that, yes, it's true that these input costs are going up, and you could say, well, the Fed doesn't care about food and energy because core inflation does not include food and energy. But you don't have that luxury if you're sitting in a business and you start to see profit margins get squeezed. So that's why this debate is really the top-down versus the bottom-up. And who wins and where inflation ends up, we'll find out, of course, over the next several quarters. But the key conclusion at this point is that the Fed's new framework, to your question, is certainly one where there's a lot of weight on the top-down perspective, and essentially saying, well, we know commodity prices are going up and input costs are going up, but for now, we just see all this as transitory.
And Torsten, it strikes me, we've had this discussion on inflation. We've not mentioned the fact that there's well over $2 trillion sitting in household bank accounts waiting to come into the marketplace. And we haven't talked about some $4 trillion that President Biden's proposing appropriating to do things like infrastructure.
Absolutely. So if you look at the agents in the economy, households and companies and the government, and households have about $2 trillion in savings. If you look at the savings in the corporate sector, meaning S&P 500 companies that have a record amount of cash on their balance sheets. And finally, the government, on top of that, also has a number of new initiatives that potentially can be used also to throw more fuel on the fire here, if you will. So the risk is that the economy is coming back because the pandemic is going away, and we have significant amounts of savings, both in the household sector and the corporate sector. There's a very academic discussion about what is the multiplier on these savings. In other words, how much of those savings are going to go out to CapEx, how much is going to go out to consumer spending. But it's pretty clear that there is a lot of money on the sidelines, not only on Wall Street, but also in real pockets on the consumer side and the corporate side that potentially could also give more tailwind to the recovery. That would all be good, and that would, under normal circumstances, be very helpful for the economy. But the risk is that if we do get this into a situation where the economy gets close to full capacity and eventually exceeds full capacity, which is the forecast, if I type ECFC go on my Bloomberg screen, which is a forecast from the consensus, then you should begin to think about the risks of inflation in the second half of this year, potentially being higher than what's priced at the moment.
Torsten, always great to have you with us. That's Torsten Slok. He's Apollo Global Management Chief Economist. Coming up, the psychology of getting people over their vaccine hesitancy from former AMA President Dr. Patrice Harris. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. A story you've been following along for the past couple of days. Gas stations along the East Coast here in the United States are starting to run out of fuel as North America's biggest petroleum pipeline fights to recover from a cyber attack. From Virginia to Florida and Alabama, fuel stations are reporting that they've sold out of gasoline as supplies in the region dwindle and panic buying sets in. Colonial Pipeline doesn't expect to be able to substantially restore service before the weekend. The White House says 1 million Americans signed up for health insurance under what's known as Obamacare during a special enrollment period for those needing coverage during the coronavirus pandemic. President Biden reopened the healthcare.gov insurance markets in February. The president says the law has been a lifeline for millions of Americans, including many who lost their jobs and health insurance because of the pandemic. In the UK, a milestone that highlights the effectiveness of the country's coronavirus vaccine program. Sunday was the first day without any recorded COVID deaths in England since the pandemic took hold 14 months ago. More than 112,000 people have died since then. Vaccination is now allowing England to reopen its economy. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thank you so much, Mark. The United States has now administered over 250 million vaccine doses so far and is averaging over 2 million a week. But the rate is coming down, and President Biden is meeting with several governors a short time from now to talk about what can be done to persuade those who are reluctant to get vaccinated. To address that question, we welcome now Dr. Patrice Harris of EMED. Dr. Harris is a trained psychiatrist and served as the president of the American Medical Association. Always great to have you with us, Dr. Harris. As I just said to you, it's almost a psychological issue now. We have a significant portion of the population that seems to be reluctant to get vaccinated. How do we address that?
Well, David, thank you for having me. It's certainly good to be with you again. And the first issue we have to appreciate is that the group who have questions about the vaccine, concerns, or outright refusal are not a monolithic group. In fact, some may just lack basic information. For some, it's about mistrust and distrust, and for others, it may be politics. And so we have to make sure we are meeting people where they are. For different groups, obviously, they will be at different places. And then it's about the message, and it's about the messenger, and it's about being persistent. And I think you said today the president is meeting with certain governors because the key issue is not to give up. We need everyone who is eligible to get vaccinated when they can. And so it's about persistence, answering questions, using trusted messengers, and making sure we have the appropriate message.
Well, I wonder about that exactly, Dr. Harris. Given what you just said, does it have to be, if not one-on-one, pretty close to one-on-one with people you know, as opposed to some of the attempts like giving away a free beer in New Jersey, or here in New York now giving away tickets to the Bronx Zoo? Are those things likely to be effective, or is this really getting one-on-one with your doctor, your minister, somebody you really know and trust?
Well, it could be all of the above, but I do want to put a fine point on getting the information from your physician. I know as a physician community, we have been urging the availability of vaccines in physicians' offices. Physicians are trusted by their patients, by their communities, and we think that could play a big role in increasing the numbers of folks who want to be vaccinated. But again, it is an all-in approach. We have, since the very beginning of this pandemic, needed an all-in approach. We've needed testing, and we've needed vaccines and masks and other levels of mitigation, layers of mitigation. And so we continue to need that. And so we need to continue to find opportunities and incentives that work, and then use those incentives. And it won't be a one-size-fits-all approach.
I wonder, Dr. Harris, whether the acceptance of vaccine may be different for younger people. We're on the cusp now of having vaccinations available for the 12 to 15-year-olds. And there's talk that by the end of the year, we may be down as low as 2-year-olds. Is there a different psychological approach to that? I can imagine a world in which I say, I'm willing to take the risk, but I'm worried about my child.
Well, I think the approach is similar. It's about being transparent, answering questions, talking about the data. We're 100% efficacy in this vaccine in the study in the 12 to 15-year-olds. Now, certainly parents will have a heightened sense of worry. I'm a child psychiatrist, and I do know that parents worry a lot about their children, and they sometimes may be willing to take on issues that they don't want for their children. But again, it's the same issues, right? We want to make sure that we make sure parents have accurate information, that they know all the details, that we are transparent. We talk about the side effects. I've been very honest about my side effects so that folks have realistic expectations. And then we really talk about the risk. We know that children are less likely to have severe complications overall, but some children have had very severe consequences and complications, and unfortunately and tragically death. So it's about making sure parents appreciate the information and talk to their children about this as well. Our youngsters are pretty savvy. They keep up with the data and what's going on. Want to make sure they get accurate information from social media, from any media. But I think our methods are the same.
If President Biden were to call you up, Doctor, and say, what more could I do? What would you tell him?
Well, the one thing I would say is please make sure that we are doing all that we can to get vaccines in the hands of physicians. Patients in the community still trust their physicians, and we can be an excellent resource and source of getting more vaccine in arms. The other issue is to continue to be persistent, continue to have the conversations as he is doing today with the various governors. Again, what works in one state may not work for another. We have to make sure we are not looking at folks as a monolith. And we need to make sure that when people make the ultimate decision to get the vaccine is readily accessible. We saw early on, there were folks who were convinced by others to get the vaccine, but then they either had difficulty signing up online, or there were long lines, or there wasn't immediate availability. So we need to make sure that we are getting out the appropriate information, but also making sure that folks have access. Now, fortunately, now there's walk-in access for many locations, and so we need to continue on that trajectory.
Okay, doctor, always a pleasure to have you with us. That's Dr. Patrice Harris. She's former president of the American Medical Association and CEO of EMED. Tech stocks have been hit today, reportedly on fears of inflation. We take a look at Cathie Wood's ARK. That's next. This is Balance of Power on Bloomberg Television and Radio. This is Bloomberg Balance of Power, and we want to go back to what we recapped at the top of the hour with some breaking news from Fed Governor Lael Brainard. She's giving some prepared remarks right now as we speak, and she said in part in her prepared remarks, quote, remaining patient through the transitory surge associated with reopening will help ensure that the underlying economic momentum that will be needed to reach our goals as some current tailwinds shift to headwinds is not curtailed by premature tightening of financial conditions. So she basically said she thinks it's uncertain about inflation, but right now she thinks it continues to be well anchored and that they should stay the course. She's remaining, I think it's fair to say, something of a dove. That's Lael Brainard, Federal Reserve Board Governor. Coming up in the rest of the hour in Balance of Power, we're going to be speaking with Senator Roger Marshall. He's the new senator from Kansas who has a bill out to cut off those supplemental unemployment benefits by the end of this month. He, like many people, are concerned that may be discouraging people from going back to work, even as President Biden has new proposals about how to overcome that. So we're going to have Senator Roger Marshall joining us from this Republican from the state of Kansas. This is Balance of Power on Bloomberg Television and on Bloomberg Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. So we started out the day in the markets, the equity markets, that is to say, with the NASDAQ really selling off. A lot of pressure on tech stocks. People believe that's because there is growing fear of inflation. And I guess the thought is if you have inflation, you want to get out of really expensive stocks. And let's be frank, a lot of those tech stocks have really been fully valued. So take a look at some of the effects on the tech sector. We often look to Cathie Wood in her ARK investments. We have Emma Chandra now to take us through the story of what's happened to ARK these days.
Hi, David. Yes, we are seeing stocks coming back, as you were mentioning there, from those lows of the session that you mentioned, and certainly with regard to tech stocks, the same is very true, and the same for Cathie Wood. Actually, we are back in positive territory for the ARK Innovation Fund after or ETF, given we were down pretty sharply overnight in futures, and then this morning at the start of the session. So it has been a miserable month for Cathie Wood. The ETF down to more than 30% since the peak in February. Assets dropping below $20 billion. That's the lowest since January, and the fund actually falling for 9 out of the past 10 sessions. Yesterday's slide, actually the biggest in some 7 weeks. And as you mentioned there, of course, that fund heavily skewed to tech. Some of those biggest holders are like Tesla, Teladoc, Square, Roku, and all of those stocks have been significantly lower over the past few months or so, and they've been caught up in this tech sell-off. And as you say, a lot of that to do with these concerns about inflation and where inflation might go, both in the US and, of course, over here in Europe too.
So, Emma, we talk about inflation back here in the United States. Tell us about over in the UK, because I saw a graph actually out today from John Authors, the columnist for Bloomberg, who said actually the UK is closer to inflation than the rest of us.
Yeah, there's certainly the similar kinds of concerns regarding inflation, both in the UK and in Europe. Perhaps for the rest of Europe, a little bit further behind the UK and even the rest of the US. And all of this goes back to, of course, that pent-up demand following the pandemic, huge savings pots that are expected to be spent by people as economies reopen. And, of course, you've got those concerns coming in there. And, of course, the concerns, of course, we're seeing in the broader market as we're seeing the likes of commodity prices rising exponentially and what those might do. But of course, there is a debate over this, David, and it's whether or not, when or how central banks might start to move. And certainly, what we have heard from the likes of the Bank of England, the ECB, and of course the Fed is that they're going to be very cautious and they expect inflation to be transitory. And so we're seeing this debate among investors and fund managers over whether or not they really should be getting worked up about inflation right now, or whether they can just sit tight and really hope that monetary policy remains accommodative.
Okay, thank you so much to Emma Chanda for that report on what's going on with tech and inflation. As Emma says, when you talk about inflation, it's a very short step over to what the central banks should do. We heard actually in a column out earlier today and then on Bloomberg television from Bill Dudley, the former New York Fed president, who is now a columnist with Bloomberg. And he wrote a column saying that the Fed may actually surprise us both in the timing of the increase and how big it might be. Here's part of what he had to say.
The Fed has said that they're going to be very slow to raise interest rates. They're not going to begin to raise interest rates until they get to full employment, 2% inflation, and they're confident that inflation is going to go above 2%. So we know that's going to take a while to convince them of that. Once they start, however, they're going to be late and they're going to have to catch up. And so this is going to be a period of slow, and then it's going to be a period of fast. And I think the thing that people don't really fully appreciate is when they actually have to catch up, the level of short-term rates is going to climb much higher than what's currently priced into financial markets.
What you just heard there, folks, is a synthesis of history with economics that Bill Dudley was legendary for with McKelvey at Goldman Sachs. Bill Dudley, I'm going to cut to the chase. In your wonderful essay, you talk about that process of moving from the reality ex post, we're behind, and forward. You talk about talking. And then the Fed will act, and finally they will do higher rates. Will they do it in a measured way, or do we literally go back to Arthur Burns, where they're going to be talking about eighth point or higher moves?
I think they're going to have to move relatively quickly, because liftoff in terms of short-term rates isn't going to happen until the economy is already at full employment. So there's going to be a big gap between where they are starting and where they need to be to keep the economy from overheating. So it seems to me that at least a quarter point a meeting seems like the most likely template. Think about what happened in 2004 to 2006. The Fed raised a quarter point a meeting for, I think it was 17 meetings in a row, taking the federal funds rate from 1% to 5.25%. Probably not going to go quite that high this time, but we're going to go quite a bit higher, I think, than the 2% that's currently priced into financial markets.
So, Bill, how would you characterize this? Is this a race back to neutral once you do start, or a race through neutral?
Well, you have to go beyond neutral, because you're starting because you're already at full employment and inflation's likely to go above your 2% inflation objective. So you actually have to go to tight.
How much of a stabilizing force do you think the market would be in that environment? Just having a look back at late 2018 as a case study to think about.
Well, it's going to be interesting to see how the market reacts. That's the one thing that could slow the Fed down. If the market reacts really poorly, then the Fed will sort of hold back a little bit. But look what happened, though, between 2004 and 2006. The Fed tightened every meeting for over 2 years. And guess what happened? The stock market was fine and the bond market was fine. So you're absolutely right. How the markets react will affect the pace of tightening when the Fed starts.
Are you advocating for a change of policy then, Bill, or just highlighting where you think the risks lie?
I think I'm just highlighting where the risks lie. I mean, there are benefits of what the Fed's doing. It's going to keep inflation expectations better anchored. It's going to get those 8 million people that are still out of work, post-COVID, back to work more quickly. But there are costs on the other side. And people in financial markets just need to be cognizant of some of those downside risks.
What do you think those costs are in the near term? Druckenmiller's out in the Wall Street Journal. Stanley Druckenmiller, famed investor, of course, a legendary hedge fund manager, saying the following: the long-term risk from asset bubbles and fiscal dominance dwarf the short-term risk of putting the brakes on a booming economy in 22. What do you make of that aspect of it, Bill?
Well, I think the Fed does recognize that financial markets are frothy, but they're looking through that because they especially for the equity market, they say the equity market, if the equity market were to go down at some future point in time, they don't see as a big risk to financial stability because investors in the equity market typically don't do so on a highly leveraged basis. If you remember what happened in the great financial crisis, it was leverage that killed us. So the Fed's view is if we tighten and the stock market goes down at some subsequent period of time, that will tighten financial conditions, and we may then not have to tighten monetary policy quite as much. But they agree that markets are frothy, but they're looking through that. They're determined to keep rates low until they actually get a lot more people back to work.
That was former New York Fed President Bill Dudley on Bloomberg earlier. I want to turn back to the jobs numbers from last Friday now. Jobs numbers fell short of what was expected, and some have said it's in part because we're paying people too much on unemployment insurance, something President Biden has denied, but yesterday he announced a new program that appeared to address the issue.
Anyone collecting unemployment who is offered a suitable job must take the job or lose their unemployment benefits. There are a few COVID-19 related exceptions, so that people aren't forced to choose between their basic safety and a paycheck. But otherwise, that's the law.
We welcome now Republican Senator Roger Marshall of Kansas, who has introduced legislation that would go further than President Biden and end the supplemental unemployment insurance altogether by the end of this month. So, Senator, thank you so much for being with us. Really appreciate it. You heard what President Biden said yesterday. Does that take care of your problem?
Unfortunately not. You know, the first time I sat down with Senator Bob Dole, asking me a very serious question, he said, Roger, go back to Kansas and listen to the people. They'll tell you the answers. And I would just encourage President Biden and his staff to go sit down with some employers and see that the number one problem holding this economy back is a lack of people for the jobs we have. People unwilling to go back to work. I talked to thousands of people over the past 10 days, and everybody is out of workers. I talked to a group that has a company that takes care of folks with disabilities, and they typically have 200 employees. They're 70 people short. I talked to a hotel industry company, and they've increased wages by 20%, but they still can't get people to come back to work. It's a bigger problem than the president is acknowledging, and it's his policies that are driving these problems.
So, Senator, you talk to constituents back in Kansas. I talk to people around New York, people who run restaurants, who anecdotally say the same thing. They're having trouble getting workers back because they get paid too much money on unemployment. At the same time, the data, as people at the White House point out, don't necessarily confirm it. For example, I'll give you one data point, which is if you look at April jobs numbers, the men were employed to a much larger degree and the women lost work. And there isn't any difference in the unemployment rates between men and women. Why is that? Some people think it's because of the problem with schools, because the women tend, whether rightly or wrongly, to be the ones staying home with the kids.
Oh, you nailed it. And I think, again, the president and the Democrat Party has to shoulder some of this responsibility. They've been so ambiguous on the rules for getting kids back into school. The kids should have been back in school 6 months ago. So if anyone's kids aren't back in school, then you need to talk to your school board and figure out why, because all the science points that it's safe for kids to be in school. But you're absolutely right. I used to help employ about 300 nurses, and certainly child care was the #1 issue. And if we had a snow day, the schools were closed, but guess what? The hospital was extra busy on snow days, if you can imagine. So it's been a challenge we've had to take care of for decades, continues to be a challenge. We need the kids in school. And then we could talk about child care just for a second as well. It's been a huge problem for decades. I was speaking back with my hometown this morning about some type of a co-op for helping out with the kids, the preschool kids as well. So I don't think the federal government's going to solve this, but they could sure make it worse.
Well, that's interesting, Senator, because you're not only a senator, you're a doctor. I mean, and in fact, as I understand, an obstetrician and a pediatrician. So you really know about this issue. Given what you just said, it sounds like you should support what President Biden is proposing for child care.
Well, look, I guess where to draw the line. When in 2017, we doubled the tax credit for childcare already. Is there an opportunity to do more? You know, maybe so, but throughout Kansas, there's communities that are solving this. I think of Salina, Kansas, the YMCA, and they've started a co-op for childcare, which is very effective. I'm just afraid when you start having the federal government solve the problems, they make too many rules and not all the dollars reach the kids that where the help is needed. So I'm just afraid, I'm skeptical of the federal government stepping in here to solve this. I'm afraid they're going to waste a lot of money. I'd rather let local communities try to figure this out on their own.
So, Senator, let's talk about one area that maybe we would agree that the federal government should have a role, and that is as cybersecurity, particularly for our infrastructure. Let's talk about the Colonial Pipeline situation. You are on the Energy Committee. What do you make of that problem? What needs to be done?
Well, there's no simple solution. We've been studying this problem since I got to Congress 4 years ago, and I actually think we need to start going on the offense, and when people blow us up, unliterally speaking, not literally speaking, with viruses, there needs to be some type of repercussion to those, and I think the military is working on that. But I think what this demonstrates is the vulnerability. If we would electrify cars, if we electrified all of our cars, we'd have to increase that infrastructure by 60%. And then when we had a huge event like the Arctic blast we had or the brownouts in California, it wouldn't just impact the heating of our homes or the cooling of our homes, it would impact our transportation as well. So we got to be careful putting all of our eggs in one basket when it comes to energy, and we certainly can't get energy policy ahead of the energy technology that we have today. So I think this all comes together. Technology can be our friend or it can backfire like it did in this case.
Should we be setting aside, appropriating more money for infrastructure to protect our grid?
Oh, I think it's a great point. I don't know if it needs more money or more target focused. I kind of feel like right now up here, we got 20 different committees and groups in the federal government trying to solve this problem. I think we need to bring some of those resources to better so we're not reinventing the wheel each time. So I'm not sure we're using the money most purposeful. I really believe that our military, our defense folks will probably figure this out quicker than some of the other agencies.
On your reference to electric vehicles, it does strike me there are some people right now in the South and the East who wish they had an electric vehicle because it turns like they can't get gasoline right now because of this problem with the pipeline. Is that an argument actually that we should be promoting more electric vehicles?
Oh my gosh, this is all a product of President Biden's policy. He wants to purposely drive up the cost of gasoline. All of his policies are creating this nonsense. When you stop exploration in national forests, those types of things, national lands, this is what's going to happen. When you keep piling so many regulations on top of us, it's going to crush us. Why? Just what? 5 months ago, gasoline was less than $2 a gallon at the pump. Today, it's over $3. It's because of President Biden's far left radical policy, and that's where we're going to end up. Gasoline is going to be $5 a gallon by Christmas time if we implement all these Green New Deal policies. So yeah, if your goal is to drive the cost of gasoline up to what it truly costs to run an electric car, then you're on your way to do that right now. We had energy independence 5 years ago, saved American lives, contributed vastly to our economy. One of the great reasons this economy flourished pre-COVID wasn't just the tax cuts and the deregulations. It was this energy policy that led to cheaper, clean energy. And I want to emphasize cleaner, that right now we're at a 25-year low for carbon production for this country. Need to keep going in that direction, but we can't drive the cost of energy up so much that the socially disadvantaged people can't afford to put gas in their car or to heat their home.
Okay, Senator, thank you so much for spending time with us today. Really appreciate it. Senator Roger Marshall, he's Republican of Kansas. Coming up, the harsh lessons of the pandemic were felt in nearly every school as shuttered classrooms forced students online. My conversation with Dan Rosenzweig, he's the CEO of the edtech company CHEGG. That's been in the forefront of that sea change. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The pandemic changed the face of education in the United States, accelerating dramatically the move to online and hybrid learning. One of the companies at the forefront of that move is CHEGG, an American ed tech firm that focuses in particular on higher education. Welcome now the CHEGG president and CEO. He is Mr. Dan Rosenzweig. So welcome. It's great to have you here. So give us a sense of how this pandemic did change upper education, higher education from your point of view.
Yeah, I'll just start with the research information, which is fascinating. So we are the largest direct-to-student higher education company there is. So we reach over 30 million students. We have over 6 million subscribers, and so we have really good insight into what students think and into how they feel about their schools and how they feel about the pandemic. The interesting information that we've seen, of course, it's been really difficult for students and professors and everybody. But what we've seen is this. Before the pandemic, only about 25% of students say they wish that they had the ability to take some classes online. Now it's 75% of students. 75% of students now say a year and a quarter later that they wish their schools were hybrid, whereas the schools themselves, only 44% of professors say that they wish they could teach hybrid. The ones that think they should and want to teach hybrid are what you'd imagine. They're the community college professors, the ones where the time, the commute, the expense is really inefficient. So we're beginning to see a big change in the way students believe they should be taught, what's available, what's on demand. They don't want to have to come to campus. They don't want to have to pay those prices. And we're still seeing the reluctance at the four-year traditional colleges because professors have lived in a bubble. They've been able to control time. They teach few classes. They have the summers off. And that's not what the modern student wants these days.
So talk to us about the finances of it all. I mean, higher education was under a lot of financial pressure, a lot of places before the pandemic hit. If we do end up going to some form of hybrid, are people going to be willing to pay as much in tuition?
No, and they shouldn't. So what the reality is, technology in every other industry has allowed for access to increase, the ability to do things on demand, which means geography becomes less relevant, time of day becomes less relevant, and personalization. So they can actually teach you at the level that you're able to be taught. And because of technology and because of the scale and because of the price it brings down, the cost of education should be less. The question that now students are beginning to understand is a difference between what they're willing to pay for the degree and what they're willing to pay for the other parts of the experience. And that became a really big topic at the end of last school year because students were disappointed that they were paying the same price as if they were able to live in the dorm or if they, going to all the sports events or having all the other clubs. There's a value to that, but it's not the same.
Dan, finally, I understand that you have a fair amount of the work done for you remotely in India, like many tech firms do. We all are very cognizant of the tragedy that is ravaging through India right now with the pandemic. Give us a sense of your workers. What's your experience been of your people there?
Yeah, we have a substantial percentage of our employees there, and they're full-time employees. And what we've seen and what we've heard, and we're in constant communication with them, of course, is that about a third of them either have the virus or somebody immediately in their family has the virus. And that is something that is just terrible. In certain cities like Bangalore, they're in total lockdown. And so we're trying to provide medical benefits, home care benefits, streaming benefits, education benefits. We're paying for them so that they can get food delivered to their home. Their child can learn in the home. It has really been devastating, and it doesn't look like there's an end to it anywhere in sight. And it really just came out of nowhere. It was entirely unexpected. And so it's a very scary situation right now.
First and foremost, as you say, this is a humanitarian crisis, and the tragedy is almost unimaginable in India right now. I don't want to avoid that. At the same time, does it have potential business ramifications for CHEGG?
Well, we're very fortunate in that we have a company that puts student first on the outside, and we have a mantra, put family first on the inside. And so the American teams, the Israeli teams, the teams around the world are picking up the slack for their Indian colleagues without even being asked to, because they understand that, each of our countries has gone through it. This is worse than many of our countries have gone through. And so they're stepping up and filling in any time or gaps without even being asked. So on our business, it'll have no negative impact. But of course, on our people and our emotions, it'll have dramatic impact.
And finally, come back to the pandemic here in the United States, what it's done for your business. Could you give us a sense of how much, let's be frank, you benefited in your business because you had to go to hybrid and remote learning, and how much of that can you hold after the pandemic's over?
Yeah, it's a very fair question. I'll break it into two. In the United States, we haven't actually benefited the way people think we have, which is we were already accelerating our growth. We did see acceleration during the pandemic, but it had to do with other business decisions that we had done, like blocking account sharing, which happened to coincide with when people went home for the pandemic. And so we actually have all the research now. Some students have gone back. Some students have gone back and done hybrid, which is they take classes from their rooms, and some students are still remote. We've seen the same growth, conversion, renewals, and engagement from each of them. Where it did actually help us dramatically change for the permanent and the good was outside the United States, because there really isn't a company like CHEGG outside the United States. And so they didn't know we existed. They discovered us. And as a result of that, we've seen tremendous growth.
Great. Thank you so much. Really great to have you with us. That's Dan Rosenzweig. He's president and CEO of CHEGG. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. Programming note now, Bloomberg Tech is doing a special on the tech industry in Boston. Guests include the chairman of Moderna and Boston's interim mayor. Watch the program tonight at 5 p.m. Eastern Time. Coming up, Balance of Power continues for a second hour on Bloomberg Radio. We'll talk about the Iranian nuclear talks as well as the Colonial Pipeline. That does it for Balance of Power on Bloomberg Television and Radio.